Let me start with something that happened just this morning that most people are going to completely misunderstand. The government released the jobs report for May 2026 at 8:30 a.m. Eastern Time today. And on paper, it looks incredible. The U.S. economy added 172,000 jobs last month. Unemployment is sitting at 4.3%. And here is the part that really caught everyone off guard. Wall Street was only expecting about 85,000 jobs, so the economy created more than double what the experts predicted. That sounds like great news. That sounds like everything is fine. That sounds like America is doing amazing. And then the stock market opened. The Nasdaq dropped 4.77%. The S&P 500 fell 2.64%. The Russell 2000 was down 3.47%. Treasury yields shot up. And over $1 trillion in market value was wiped out in a single session. So let me ask you a simple question. How does a great jobs report destroy the stock market in one day? How does more people working lead to stocks crashing? How does good news become the worst thing that happened to your portfolio this week? That is exactly what I am going to break down for you today. And more importantly, I am going to tell you exactly what this means for your money right now. Not just what happened, not just the news, what you should actually do about it, because that is the thing that almost nobody is talking about. Here is what you need to understand first. The stock market and the economy are not the same thing. I know that sounds obvious when you say it out loud, but almost every single person treats them like they are identical. When the economy is good, stocks go up. When the economy is bad, stocks go down. That is the assumption most people walk around with every day. But that assumption is wrong, and today is a perfect example of why. The stock market is not a measure of how well regular Americans are doing. The stock market is a forward-looking machine that prices in expectations about the future. And right now, the single biggest expectation that investors have been betting on for months is that the Federal Reserve would start cutting interest rates again. Let me give you some context. The Fed cut rates 3 times in late 2025. Each cut was 25 basis points, which is 0.25%. By December of last year, they had brought the federal funds rate down to a range of 3.5 to 3.75%. And every time they cut, the market celebrated. Stocks went up, bonds rallied, everything felt good. But then 2026 started and the Fed stopped. They looked at inflation, which is still stubbornly running above their 2% target. They looked at GDP growth, which came in at 1.6% in the first quarter and is tracking around 3% in the second quarter, according to the Atlanta Fed. And they said, we are going to wait and watch before we do anything else. And ever since then, every single piece of economic data that comes out gets filtered through one question. Does this make a rate cut more likely or less likely? A weak jobs number? Rate cut more likely. Market goes up. A strong jobs number? Rate cut less likely. Market goes down. That is the world we are living in right now. And that is exactly why this morning's report hit so hard. 172,000 jobs, more than double expectations. Unemployment unchanged at 4.3%. The labor force participation rate holding steady at 61.8%. Wages still growing. The broader unemployment measure, the one that includes people working part-time who want full-time work, actually edged lower. From a pure economic standpoint, this is a healthy labor market. The chief economist at Navy Federal Credit Union said this morning that the hiring recession is over. She called it a strong report from every angle. Ellen Zentner, the chief economic strategist at Morgan Stanley Wealth Management, put it plainly. More solid jobs data leaves the Fed where it has been for a while, watching and waiting. And that is the problem. That is why markets fell apart today. Because the Fed was already not cutting rates, and now they have even less reason to. The 10-year Treasury yield jumped to 4.54% after this report came out. When yields go up, it puts pressure on stocks. Higher borrowing costs mean companies pay more for debt, which eats into profits. Higher yields also mean bonds start competing with stocks for investor attention. And when you can get a relatively safe 4.5% yield from government bonds, a lot of money starts moving out of equities. So here is the full picture of what happened today in plain English. The economy created a lot of jobs. That is genuinely good for workers. But it also told the Federal Reserve that the economy does not need help. The Fed does not need to stimulate anything. So they are going to keep rates exactly where they are, which means borrowing costs stay high, which means mortgage rates do not come down anytime soon, which means the pressure on consumers does not let up, which means company earnings growth gets squeezed. And the stock market, which had been pricing in some hope of relief, had to reprice itself to reflect a world where that relief is not coming. That is not a 10-second story. Most channels are going to give you the headline: NASDAQ crashed, jobs were good. Confusing, right? Next video. I am giving you the actual mechanism, the reason behind the reason, because when you understand this, you make better decisions with your money. Now let me talk about what this actually means for you, because I want to break this into 3 groups. If you have money in the stock market, if you are trying to buy a house, and if you are just trying to manage your money day to day through all of this. Let's start with the stock market. If you looked at your 401k or your brokerage account today and felt your stomach drop, I want you to take a breath. A single day decline, even a sharp one like today, does not define your portfolio's future. What I am more concerned about is the pattern that is building underneath the surface. The broader issue is not today's jobs report in isolation. It is the combination of factors that are stacking up at the same time. You have inflation that is still above target. You have a Fed that is on hold. You have Treasury yields that are rising, which puts pressure on valuations for growth stocks. You have a semiconductor sector that was already under stress after Broadcom's earnings earlier this week triggered a sell-off. And now you add a jobs report that removes any near-term hope of rate relief. That is a lot of headwinds hitting the market at the same time. And when multiple headwinds converge on the same day, you get the kind of number that flashed across your screen this morning. Here is what I personally think makes sense right now based on what I am watching. This is not financial advice. This is just my thinking, and you should always consult a professional for decisions specific to your situation. I would be looking at the quality of what I own. Not just the ticker symbols, but what those companies actually do and how much debt they carry. In a higher for longer rate environment, companies with heavy debt loads and thin profit margins feel the most pain. Companies that generate strong free cash flow, carry manageable debt, and actually earn consistent profits, those tend to hold up better when rates stay elevated. I would also be thinking seriously about diversification beyond just U.S. large cap tech. The NASDAQ getting hit nearly 5% in one day is a reminder of how concentrated that index has become in a handful of names. A rough earnings season for semiconductors, a secondary offering from a mega cap name, and suddenly the index everyone thought was bulletproof drops $1 trillion in one session. And I would not be making panic moves. The absolute worst thing you can do right now is sell everything because fear spiked today and then watch the market recover while you are sitting on the sidelines in cash. If your time horizon is 5, 10, 15 years out, a single Friday in June 2026 is not going to define your retirement. What will define it is the consistency of your decisions over time. But if you are someone who had a heavily leveraged position in high-growth tech stocks, counting on rate cuts to lift everything in the second half of this year, that is a position worth revisiting honestly. Now let me talk about housing, because this is where today's report hits differently for millions of people. If you have been waiting for mortgage rates to come down before you buy a house, I need to be straight with you. Today's jobs report made that wait longer. Mortgage rates track closely with the 10-year Treasury yield. The 10-year jumped today, which means any near-term relief on mortgage rates just got pushed further out on the calendar. The Fed is parked at 3.5 to 3.75%. They have made it clear they are not moving until they see more progress on inflation. And now the labor market is strong again, which gives them absolutely zero urgency to do anything. I know that is not what you want to hear if you have been watching home prices hold at elevated levels while you waited for rates to drop and give you room to actually afford a monthly payment. But the honest picture is more useful to you than something that just sounds better. What does that mean practically? It means if you are in the market for a house and you find the right home at a price that works with your budget right now, factoring in rates right now, that may still be the right decision for your life. You can always refinance if rates eventually fall, but you cannot unlose the years of rent you pay while you wait for a timing that may not come when you expect it. On the other hand, if you are stretching your budget to the absolute limit and banking on rates dropping in the next 6 months to give you financial breathing room, that is a risky bet in an environment that just got messier. Today told you the Fed is not in a hurry. Act accordingly. Now let me talk about something that applies to everyone, regardless of whether you own stocks or are trying to buy a house or are just trying to figure out how to handle your money through all of this. The good news is bad news dynamic that played out today is not a one-time thing. It is going to keep playing out. And understanding it changes how you filter the financial news you consume every week. Here is the core tension sitting in the middle of everything right now. The Fed wants to cut rates eventually because high rates hurt regular consumers. High mortgage rates, credit card interest rates sitting near record highs, high auto loan rates, high rates on small business borrowing. All of that squeezes American households every single month. But the Fed also has a job to do on inflation. They need to get it back to 2%. And a labor market that is this strong, 172,000 jobs added, wages growing, participation stable, is not sending a signal that says the economy needs emergency help. So they stay put, and the squeeze continues. This is the thing I want you to take away from today beyond just the numbers. We are in a period where the economy and your personal financial situation can feel disconnected in a way that is genuinely confusing. A strong jobs report should make you feel financially secure. But today, it made your mortgage prospects worse, your stock portfolio smaller, and your timeline for rate relief longer. That is not how most people think it is supposed to work. But that is the reality of the current system. So, let me be practical. Let me tell you the specific things worth looking at right now based on today. If you have credit card debt, treat it with urgency. Rates on consumer credit are not coming down soon. Every month you carry a balance at 22 to 24% interest is a guaranteed return on investment if you pay it off. You will not find that guaranteed return anywhere in the market right now. If you have cash sitting in a standard bank savings account earning 0.5%, today is a good enough reason to make the switch to a high-yield savings account. The best ones right now are paying around 4 to 4.5%. On $10,000, that is the difference between earning $50 a year and earning $400 to $450 a year. That is real money for a phone call or an online application. If you have money in money market funds or short-term treasuries, that is a reasonable place to be in this environment. You are earning a decent rate, you are not exposed to equity volatility, and you have flexibility when the picture eventually shifts. If you have an emergency fund, make sure it is fully funded before you make any aggressive moves elsewhere. An emergency fund that covers 3 to 6 months of expenses is your buffer against being forced to sell investments at a bad time. If that buffer does not exist, building it is the highest priority right now, regardless of what the market does. I want to address the question I know is sitting in the back of a lot of people's minds right now. Is this the start of something bigger? Is a real crash coming? Here is my honest answer. Nobody knows. And I mean that. Not me, not the analysts on CNBC, not the economists who have been right 2 times out of 10. Markets are not predictable on a short-term basis, and anyone who tells you otherwise is either selling you something or overconfident in ways that should make you nervous. What I can tell you is what the actual risks are based on what the data says right now. The risks are inflation staying sticky and forcing the Fed into a higher for longer position that extends well into 2027. That risk just got bigger today. Geopolitical uncertainty continuing to pressure oil prices and global supply chains. Treasury yields rising further if economic data keeps coming in strong, which would pressure both the stock market and housing simultaneously. And consumer sentiment, which has been surprisingly weak despite a healthy labor market, deteriorating further as people feel like financial relief is perpetually just around the corner and never arrives. The things that could shift this picture: a series of inflation readings that show real, sustained progress toward the Fed's target, a genuine softening in labor market data that gives the Fed cover to move again, or some resolution to the geopolitical tensions that have been a constant source of market anxiety this year. None of those things happened today. Today was a day that made the current picture feel more locked in, not less. And the honest response to a locked-in picture is to make sure your own financial foundation is solid, not to try to predict when the lock opens. Here are the principles that hold up in confusing environments like this one. Do not let market noise drive you into decisions that hurt your long-term position. Selling in fear and buying back higher is the most reliable way to destroy wealth over time. That cycle has repeated itself throughout market history, and it will happen again to the people who let a bad day convince them to blow up their strategy. Make sure the risk you are carrying matches the risk you can actually afford. If money you might need in the next 2 or 3 years is fully exposed to market volatility right now, that is worth looking at regardless of your optimism about the long term. Do not ignore the boring moves. Paying down high-interest debt, making sure your cash is earning a real return, keeping your emergency fund intact. None of that is exciting, but all of it compounds. The people who are in the best financial position in 5 years are usually the ones who took the boring stuff seriously when everything felt chaotic. And stay informed for real, not just the headline, but the mechanism. When you understand why something happened, not just that it happened, you respond differently. You are less scared, more deliberate, and more likely to make decisions based on your actual situation rather than whatever emotion the news cycle is trying to trigger in you. Today was a complicated day, a day where a great number on paper created a genuinely bad outcome for markets, where more people working made your mortgage harder to get and your portfolio smaller, where the economy did something impressive and your savings felt the cost of it. That kind of day is disorienting. And the answer to disorientation is not to freeze or to panic. The answer is to understand what is actually happening and make clear-headed decisions about what you can control. If this breakdown helped you see today more clearly, I want you to subscribe right now, because this is what I do here every single time something moves the market. I do not just tell you what the number was. I tell you what it means for the money in your account and what you should be thinking about doing with it. And in a market like this one, that clarity is genuinely worth something. Next week, I am going deep on what happens to your 401k, specifically if the Fed holds rates elevated through the end of 2026 into 2027. The math on this is something most people have never seen broken down clearly. It directly affects every working American with retirement savings, and it is going to change how you think about your contributions right now. Make sure you are subscribed so you do not miss it. I will see you then.